Good evening and welcome everyone. Thank you for joining us today to discuss TCS financial results for the third quarter of fiscal year 2018, ending December 31st, 2017. This call is being webcast through our website and an archive including the transcript will be available on the site for the duration of this quarter. The financial statements, quarterly fact sheet and press releases are also available on our website and have been emailed out to those on the mailing list. Our leadership team is present on this call to discuss our results. We have with us today Mr. Rajesh Gopinathan, Chief Executive Officer and Managing Director.
Hi, good evening everyone.
Mr. N.G. Subramaniam, Chief Operating Officer and Executive Director.
Good evening everyone, pleasure to be here.
Mr. V. Ramakrishnan, Chief Financial Officer.
Hello everyone.
Mr. Ajoy Mukherjee, EVP and Head of Global Human Resources.
Hi everyone.
Rajesh and Ramki will give a brief overview of the company's performance, followed by the Q&A session. As you are aware, we don't provide specific revenue or earnings guidance, and anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. We have outlined these risks in the second slide of the quarterly fact sheet available on our website and emailed out to those who have subscribed to our mailing list. With that, I would like to turn the call over to Rajesh.
Thank you, Kedar, and once again, good evening and good day to all of you. And let me start by wishing all of you a very happy New Year, very happy 2018. It's my pleasure to start off the new year with a discussion on our December quarter, which turned out to be fairly strong considering the seasonally weak nature of this period. We had strong deal closures, particularly in digital, which we'll talk about in more detail later on. We had a robust volume growth of 1.6% Q-on-Q, the strongest we have had for a December quarter in the last 3 years. On a year-on-year basis, we grew 9.1% in USD terms and 3.9% in INR terms and 6.2% in constant currency. On a sequential basis, we had a revenue growth of 1.3% Q-on-Q in constant currency, 1% in USD terms and 1.2% in INR terms. Let me now give you details of our segment performance. On a year-on-year basis, with the exception of BFSI and retail, all other industry verticals continue to show revenue growth upwards of 9.5%, with 4 of them growing in double digits. 2 of our verticals, energy and utilities and travel and hospitality, grew in fact about 20%. On a sequential basis, I am happy to report that our retail and CPG vertical showed a good turnaround, growing at 6.4% Q-on-Q. Other than that, we had growth coming in from energy and utilities at 8.5% Q-on-Q, travel and hospitality at 2.9%, life sciences, healthcare and CMI all upwards of 2.5%. The laggards in this quarter were BFSI, which declined 1.5% Q-on-Q, and technology and services, which grew marginally at 0.1%. Seasonal headwinds affected both these verticals, more so in BFSI due to pre-existing softness in that industry, which we have spoken about in the past. We had a very strong set of deal wins in Q3, nicely distributed across industry verticals and regions. Of the 11 key wins, we had 3 wins in BFSI, 2 in retail and energy and resources, and 1 each in manufacturing, CMI, healthcare and technology. From a geography perspective, year-on-year growth was led by continental Europe, which grew 22.3% year-on-year, and UK, which grew at 8.2%, and APAC at 6.2%. North America continued to grow below company average on account of softness in the BFSI and retail over the last 1 year. On a sequential basis, North America, continental Europe and Latin America grew above the company average. After a steep decline last quarter, India stabilized in Q3. From a deal perspective, of the 11 key wins in Q3, we had 5 in North America, 3 in Europe, 2 in UK and 1 in APAC. In the last call, I had spoken about the new Business 4.0 world that we are living in, characterized by a technology-driven transformation of business into smarter and more agile enterprises capable of harnessing technology-enabled abundance to personalize, leverage ecosystems, embrace risk and deliver exponential value. This Business 4.0 framework that TCS has embraced and taken to its market, to its customers, is resonating very well, and we see customers embrace this vision and use this framework to accelerate their transformation with TCS as their preferred partner. As a consequence, we are seeing digital deal sizes that have been steadily trending up over time. In Q3, we crossed a key milestone, signing our first 50 million plus digital transformation deal. While a deal of this scale is still relatively rare, confined to mostly most technologically progressive customers, we believe that this is the shape of things to come as more and more organizations start implementing their long-term digital strategies. In fact, it's more than that. It's really a unique combination of the power of digital combined with TCS's understanding of the technology, the domain knowledge that we possess, and the contextual understanding that we have of the specific requirements of our customers, which is enabling us to stitch together these offerings into transformative and large-scale opportunities where we are uniquely positioned to compete. Revenue from digital engagements made up 22.1% of our overall revenue this quarter, an industry-leading growth of 39.6% year-on-year. The setting up of dedicated service practices within our business and technology services unit targeting the various digital areas is giving us tremendous market focus, as is evidenced by over 150 wins that we have seen in this quarter. We listed a few of those in our press release to give you a flavor for the kind of work that we are doing for our customers. Strong customer references for the transformational work we do for them and the very evident market success is resulting in high rankings in the various assessments published by industry analysts. In Q3, TCS ranked as a leader in 14 digital-related assessments by independent industry analysts. From a client metrics perspective, we had a good Q3 with strong additions across revenue buckets. During this quarter, we added 3 clients in the 50 million plus band with additions across all the other bands. Our strong client metrics are a direct outcome of our customer-centric business model, and as we've spoken about many times in the past, our deep contextual knowledge and the trust that we have developed through our long engagements with our customers. And this has become a very critical differentiator, as I spoke to you about our unique ability to enable all of this together to actually use the Business 4.0 framework to drive growth and transformation across our customer segment. From a products and platforms perspective, speaking of Business 4.0, when we apply these core concepts to our own business, the elements best positioned to deliver exponential value in the long term are our products and platforms. Our TCS Bank's product suite for the financial services industry had 4 new wins and 8 go-lives in Q3. I'm particularly excited by Quartz, the blockchain solution we launched for financial institutions earlier this year. As you all know, distributed ledger technology is showing immense promise in many different areas, and I'm convinced will substantially transform how business is transacted in the future. To begin with, we are focusing on a few select use cases: corporate announcements, loan securitization, trade finance, and card payments, but its usage will continue to increase across the spectrum. In Q3, Quartz had 4 wins, including the engagement with BNP Paribas Security Services, for whom we very rapidly deployed Corporate Event Connect, an innovative blockchain-based platform that uses Quartz to provide fast, accurate, and secure corporate event announcements to BNP's clients around the world. When you look at Ignio, and we're very encouraged by the rapid gains that it is showing in the market. Ignio had more than 10 wins this quarter. And when you look at the large wins that we announced, you will find that more than 4 of them were leveraged Ignio very deeply. What's more important is that Ignio, which was started as primarily focused on the infrastructure space, is rapidly evolving into a full spectrum cognitive automation and orchestration platform. The deals you will see are distributed between infrastructure, enterprise applications like SAP, healthcare, analytics, etc. So we are seeing automation and intelligent analytics getting deeply embedded across the spectrum, and Ignio is a great driver for this transformation. Ignio now is approaching close to 50 customers with strong wins this quarter. On terms of other platforms, TCS HOBS is a pre-integrated end-to-end platform for telecom business and operation support, and it won 2 new customers in Q3, bringing the total number of customers to 27. Other platforms like TAP and Optimera had 1 win each. And our ION assessment platform assessed more than 6 million candidates in Q3, and we now have about 100 million candidate assessments that we have conducted till date on this platform. So we are able to use technology and deploy it at a fairly unprecedented scale, and we are seeing rapid acceleration across that, and that's one of the reasons why we are optimistic about the power of these technologies to transform the businesses of our customers where we work in. On the people front, we continue to recruit steadily, and in Q3 we added 12,534 employees on a gross basis, of which almost 3,000 were recruited outside India. Net additions was at 1,667, and we closed the quarter with a total headcount of 390,880 employees. Overall, in the last 12 months, we have recruited 59,700 employees, which includes 12,700 recruited outside India, a good indicator of how our localization initiatives are progressing. We have always prided ourselves in our ability to attract and retain diverse talent. We performed very well on this front in Q3, and our attrition in IT services continues to trend down, reducing 20 basis points Q-on-Q to 11.1%. I'm also very happy to see the percentage of women in the workforce continues to trend up, and we now are at 35.2% of our associates in this metric. And this compares very well against most of our peers in this industry and across. So overall, in conclusion, if we step back and take a look at where we stand as we enter 2018, several of the headwinds that impacted our performance over the last 3 years are steadily getting addressed and behind us. Telecom and high-tech has been growing very well for us over the last few quarters. Diligenta that we spoke about, we have seen strong traction. We have seen conversion of some of the deals, and other deals in the pipeline also. We are quite optimistic about the way that whole space is shaping up. Retail has turned around. We had spoken about it last quarter, and we are now we're seeing the early stages of that recovery, and we remain optimistic about it with a one-year focus. We think that in the current trajectory, it is well placed to deliver double-digit growth in FY19, which leaves us with niggling pockets of weakness in BFSI. While we don't have immediate visibility into when we might expect a turnaround there, we hope for more positive macro triggered by the various developments in the US and other markets would probably lead to a better demand outflow or demand outlook in that space. With that, I'll conclude my opening remarks and over to you, Ramki.
Yeah, thank you, Rajesh. Let me go through the headline numbers. In the third quarter of FY 2018, our revenues grew 1.3% Q-on-Q on a constant currency basis, driven by a strong volume growth of 1.6%. The cross-currency movements resulted in a minus 0.3% impact revenue Q-on-Q in USD terms, and a minus 0.1% impact in INR terms. Reported revenue in INR was rupees 309.04 billion, which is sequential growth of 1.2% and Y-on-Y growth of 3.9%. In USD terms, revenue was $4.787 billion, which is the Q-on-Q growth of 1% and Y-on-Y growth of 9.1%. On a year-on-year basis, constant currency growth was 6.2%. With the continued focus on operational efficiency, we were able to improve our EBIT margin in Q3 by 0.1% to 25.2% Q-on-Q. Net income margin was 21.1%. The effective tax rate for the quarter was 24.3%, and our DSO for the accounts receivable was 75 days, and it was down 1 day Q-on-Q. Tighter working capital management through concerted efforts by all our teams resulted in very strong cash conversion this quarter. During the quarter, the net cash flow from operations was rupees 77.8 billion, which is 25.2% of revenue and 119.2% of net income. Free cash flow was rupees 74.1 billion. Invested funds as at 31st December was at 405.9 billion rupees. The board had recommended an interim dividend of rupees 7 per share. With that, we can open the line for questions, operator.
Thank you, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Divya Nagarajan from UBS. Please go ahead.
Hi, Happy New Year and thanks for taking my question. Rajesh, you spoke about the banking outlook. 2 questions here. Could you run us through how the banking space, BFS versus I, has shaped up versus your expectations in the quarter? And within those 2 segments, could you run us through where are the pockets of weakness and the pockets of strength that you expect in 2018?
Okay. I'll start and then I'll ask NGS to add more color to this. Related to expectations, BFSI has been somewhere in that space itself. We were expecting weakness and it continues to be there. We've seen both impact of furloughs as well as some softening of demand, which has impacted the overall performance. From a region perspective, relatively Europe is better and the weakness is more pronounced in the US. From within the sectors of BFSI, again as we spoke, the insurance space is relatively better compared to the more retail banking space. So, but these are no different from the trends that we have spoken of in the past. And I'd like NGS to add on some more color to this.
Thanks, Rajesh. I think the softness that we see in the BFSI is, pretty much attributed to seasonal factors, and in particular, only in North America. In fact, we have grown in BFSI in the rest of the world, whether it is Canada, whether it is Europe, whether it is Australia, we have grown. And we have, last quarter I articulated about the kind of digital programs that are emerging in the banking financial services space. And I'm pleased to note that we are participating in such wave 2 of digital programs. In fact, some of the digital growth that we have seen in this quarter is actually marked by a couple of engagements that we have participated in with large financial institutions. And overall, blockchain, IoT, these are kind of technologies which are gaining a lot of traction, and we see that our participation in banking financial services space in the digital engagements will continue to grow. Okay. Fundamentally, we don't see any major hurdles, and I believe that the institutions in the North America, they continue to invest internally in terms of building the skills that are required and going through the workplace and workforce transformation that they are getting into. And some of them are nearly completing it. Some of them are still, this particular aspect is work in progress. And we hope that, with the developments that we are seeing in the North America, whether it is the tax cuts or others, we believe that it should do well for the industry, and then more spending will take place across the 3 dimensions of what they will do internally, what they will do with the captives, and what they will do with partners like us.
Thanks, that's helpful. Just a quick follow-up. You spoke about retail coming back to potentially double-digit growth. What goes into that assumption? Is that the deal momentum that you've already signed and you're beginning to see? Could you just give us some color on that, please?
There are multiple things are going into it. Some of it is obviously deal momentum and the pipeline visibility that we have, and some of the deals have materialized. The most recent being a very transformative deal that we have done with Marks and Spencer. But even more importantly, if you look at what's happening in the industry, and particularly if you look at the numbers coming off the US from the last holiday season, you're seeing traditional retailers bounce back strongly with a much more integrated technology play. And it's no longer about online versus offline. It is the more traditional retailers leveraging technology to enhance their overall value proposition to the customer and taking the customer buying away from a pure pricing call to a more integrated experience and ownership call. We have seen customers like Home Depot, Best Buy, all of them emerge very strongly through this holiday season. So that's the trend that we are really enthused about. So combination of our own pipeline and what we see as transformative change in the industry is what is leading us to this optimism.
Thanks. I'll come up for follow-up later. I wish you all the very best for the year.
Thanks.
Thank you very much. The next question is from the line of Ankur Rudra from CLSA. Please go ahead.
Hi, thanks. Good evening. Thanks for taking my question. The first one in Europe, clearly, good trends continuing there. Could you maybe add some more color thematically, perhaps country-wise and vertical-wise, where you're seeing more opportunity, A? And B, is that a reason for, margin softness that Europe tends to operate at slightly lower margins than maybe a US business or Australian business? And as that increases, you will have a source of margin headwind, which you might face.
Ankur, Europe performance encouragingly is happening across a wide spectrum. So both from a vertical industry perspective as well as from a region perspective. If you even look at the deals that we have announced, you will see a very good spectrum of deals. Europe, for example, we have announced in BFS, we have announced in the EPC side, and so across the board we are seeing deal momentum. From a region perspective also, we have been strong in the Nordics and the Benelux region, and that continues to do well. Germany is performing very well for us, and even markets like France are tracking on double-digit growth now after fairly. So Europe is a broad-based story. While you are right in the fact that in Europe the deal structures are more complex and the operating environment is more complex, I would actually say that as the overall volume and overall deal sizes increase and as we gain scale in individual markets, the margin profile on a like-to-like basis will improve over time and converge with our other markets. So we are looking at Europe not still as an investment area, and we are focused on achieving scale in all the key markets there. And I'm quite optimistic that its overall profile will be not significantly different from what we've seen. It's a different construct, but not a negative construct.
That's helpful. Just on BFSI, if I could, go back to that, sounds like from what you're saying, the weakness is still concentrated in the large US banks. Is there any more source of weakness that you saw this quarter, and what needs to happen for your overall BFSI momentum to improve from here?
Ankur, this is NGS here. I think, you're right that as I explained earlier, it is limited to a few banks in the North American market. And they're all in different stages of the internal investments that they're making in terms of getting them ready for collaborative workplaces and agile, adopting enterprise agility and so on and so on. And clearly, the investments are largely in the digital area. And key thing is that I think most of them are evaluating different possibilities and technologies of artificial intelligence and machine learning, what kind of architectures that they need to deploy. I think, in the next 1 or 2 quarters maximum, I think they will have that visibility, and then they will probably finalize a strategic digital stack, including what I call as a strategic bot architecture that will span across IT, IS, and operations. As that happens, we should see that, and combined with the benefits that they see in the overall business environment, I believe that they should be spending more and balance the proportion of spend that they are making across the 3 dimensions of what they will do internally and with their captives and partners like us.
That's very helpful. Just last question on the bookkeeping side, maybe something everybody wants to know. Ramki, anything you can add in terms of color or visibility you have on the impact of this base erosion tax provision in terms of what your numbers will see maybe in the over CY18? Thanks.
So for FY18, we don't see anything because anything which is applicable from there will be from the next financial year. I think the Act has sort of come just 15 days back, and there are still some areas where there is lack of clarity, and so we are still evaluating. We are looking at the provisions and also consulting. So right now we are not in a position to say what it would have, but the fact is, of course, there is a reduction in the overall tax rate, so that will come in. And some impact definitely would be there from the BF provisions, especially on some of the intercompany transactions. So we'll have to wait and watch.
Okay, thank you and best of luck.
Thank you very much. The next question is from the line of Sandeep Agarwal from Edelweiss. Please go ahead.
Yeah, so thanks for giving me the opportunity.
Sorry to interrupt, Mr. Agarwal. May we request you to speak a bit louder? Your voice is a bit faint.
Yeah, so thanks for giving me an opportunity to ask a question. So just one question to Rajesh. Rajesh, wanted to get an update how you are seeing the digital deals. Is there a continuous trend of the deal sizes increasing, and the kind of the scale going up there, which would imply that the deals start moving a little bit from the boutique firms and the startups to the large scale players. Are you seeing that kind of trend, or you would like to give some more color or other kind of color on that?
Definitely, we're seeing increasing trend of the digital deals becoming much more enterprise-wide. And as I said earlier in my commentary, the whole point is that it is an ability to leverage the power of the new technology stack, combine that with domain knowledge, combine that with the contextual knowledge of that customer to be able to stitch together a transformation agenda. So there is the pure play deals that themselves are increasing in size, but the deal that we announced with the UK retailer Marks and Spencer, that itself is a transformation agenda. It's a complete reimagination of the technology and business operating and architecture, which leverages these technologies. It leverages new age working models like Agile and on the cloud first and the machine first delivery paradigm. So we are going beyond the concept of just digital as some point solutions or point technology ones to starting to see enterprise level architectural adoption, and that will become the norm. So I don't know whether I answered your question, but we are seeing all our large deals. The transformation agenda is very strongly driven by the ability to leverage this technology and combine that with what is currently on the ground and to stitch together a transformation agenda.
So, sorry, but if I can maybe reframe that question again, what I'm trying to understand here is that, and I understand that you partly answered that as well, but just trying to understand more like, will it be fair to call that the stage where, we, in spite of being way ahead of others in the digital space, did not get a big chunk or big share because the size is very, very small, but with sizes increasing, our share will go up significantly. Will it be fair to call that?
I think it would be wrong to characterize it that we didn't get a size, but that's beside the point. It's a question of how you look at it. If you ask me, are you confident about digital continuing to drive growth? Yes, we are very confident about digital driving growth.
Yeah, thanks. That's very helpful. Thank you.
Thank you. The next question is from Viju George from JP Morgan. Please go ahead.
Yeah, thank you for taking my questions. A happy new year to the management team. First question on people addition. I think in this Y2D, your people addition has been very measured. Is that something we can continue to expect going forward, or is this got to do with utilization? Or do you think there is a great element of automation also kicking in, which can be a sustainable factor going forward? So which means that, if you're growing at the rate that you are, you shouldn't be really having people additions.
Okay, Viju, this is Ajoy. Now, from a people addition point of view, yes, if you look at this year, it is about net basis about 3,600. And as we mentioned in the beginning, the total last 4 quarters gross level, we have done about 59,000. I think the story is the year prior to that, when we did the campus hires, when we had given about 40,000 offers, we were building capacity, we were doing the investment to create the necessary pool that was required to meet our customers' demand in terms of the digital knowledge, in terms of the digital skills, and the whole talent development that we have done in building and upskilling our people and giving them the opportunity to learn new technologies, to learn new ways of doing things, be agile trained, be aware of all the technologies and get more competencies. So that is the reason why the hiring is more controlled at this point in time. And the second part of automation, I think we have talked about the various deals that we have got and how automation is coming in and how it's helping us in our delivery model itself. So both what you said are true, and going forward again, as far as the hiring is concerned, for some time it's going to be measured and controlled based on what our demand forecast and based on what our delivery teams need, and we will go accordingly as per that.
Okay, so what I was trying to get answered is that a larger part of the muted people addition, is it due to utilization improvement, those kind of productive measures, or is it due to automation? I think it's more due to the former, right? That's what you've indicated, that you had set up capacity which you started to sort of burn.
That is true. That's true. And at the same time, automation has also helped us, because I think the number of deals that we have won, and that is also helping us. But the capacity that we created, that definitely is getting utilized.
Sure. The other question I had was on digital more broadly. Obviously, the growth here is very impressive. But if I look at the overall, revenue growth of the company, it still stays stuck in a 6 to 7% range. At some point, I know this has got to do with the weakness in BFSI. But do you think that, digital needs to get to some critical threshold for it to be self-sustaining to drive the overall revenue base? Because there is some legacy business also under pressure. Any idea what that threshold might be, given the current pressure on legacy?
I think, Viju, rather than thinking of it on a horizontal cut basis, I think it is much better to think of it from a vertical cut basis. As we have seen from specific areas we have been addressing one by one. BFSI continues to be the space, and within BFSI also we are going at it segment by segment. So I would think it's a vertical issue rather than a horizontal issue. I don't think there is a magic number beyond which it will impact. Our growth, to put it in perspective and on a comparative basis, in the reported period, we are tracking quite well overall, and we are confident that that should continue to benefit from the capacity and the capability that we built on digital.
Sure, Rajesh. Thank you, and all the best to the management team.
Thank you very much. The next question is from Shashi Bhushan from Axis Capital. Please go ahead.
Yeah, thanks for taking my question. My question again, related to BFS. What is leading to the softness in BFS? Is it that the financial health of our client, or is it their unwillingness to spend, or is it like, we are not present where the spend is happening? Is it just like, our size has reached to a level where growth is going to be suboptimal?
The best way to think about it is that we are not losing market share in BFSI. We are maintaining market share both at an industry level as well as at our client level. And in fact, in its most, we saw the maximum amount of transformation in this industry as regulatory pressures and front-end investments took over the last many years. Our market share has steadily expanded in this industry among the largest competition set. So the question of not participating is absolutely not there, and in a very objective way you can see that. The question as to is there health of clients being an issue, that's also not true. In fact, the banking industry is quite well positioned and it's well out of its blues. It had lingering provision requirements for legal about a year or two back, but even that is beyond. So the issue is more around what NGS said, that for them to start the next wave of transformation, they've done early, experimentation, but they're still in a process of actually adopting a certain architecture and thinking through how they want to do it and how they want to scale it. We see European clients, in fact, paradoxically, in this industry, way ahead of adoption of cloud and automation. In fact, areas like Agile, large European banks are significantly ahead of US banks with the extent of enterprise-wide adoption programs that they have kicked off. And our participation in all of them is very, very high. In fact, we are the leading partners for the biggest banks in Europe, which are at the forefront of adopting Agile and cloud. So we are participating very strongly. I think it's more in terms of how this spend starts off and how it impacts the larger base.
So another question regarding the IT budget. Any early indication on IT budget for CY18 for any of the verticals that you have got and shared with us?
I answered this in the press meet also, that probably the whole idea about thinking about an annual IT budget as a clear indication of where the spend is becoming dated with the technology transformation going on. Two things are happening. One is that the long-term planning cycles are no longer limited to annual cycles. They are more client-specific and more focused on their own business periods. But even more importantly, deal structures are becoming much more complex, where they encompass transformation both at the IT level as well as at the business level. So annual IT budgets probably is something that is no longer a clear indication, and we find it not very from a period perspective, typically January is still early to call it. And again, as I said, if at all we have to think about budgets, it should be across the CXO organization rather than just the CIO organization.
Thanks a lot, and all the best for the next calendar year.
Thank you. The next question is from Ravi Menon from Elara Securities. Please go ahead.
Thank you for the opportunity. Digital has shown a surprisingly good acceleration. Right? So I think somebody had asked this question in a different fashion, but let me try take another stab at this. So is this led by a broadening of adoption or bigger deal sizes? And how sustainable is this growth momentum in digital, given that your base is now quite large?
So 39% is not something that I would say here or bet on. But the answer is to your question is that it's a deepening of adoption rather than just a broadening. So the last year or so was about broadening of the digital adoption with more and more of our clients experimenting across the board with these technology stack. But the reason these deal sizes are increasing is because we are seeing the depth increase and actual leverage happening across the full architecture of a client in a given business unit or a business process or a overall transformation agenda. So it's depth that is driving it rather than breadth.
Right. And would you say that this is, this should continue for some more time? And are there any pockets where you see, people have not really gone into this or experimented with it, or are still in very early stages?
Yes, at the depth that we are talking of, it's still early stages. There are only a few that have really embarked upon full enterprise-wide transformation and committed to large programs. So that would be very much at the early stages of that.
Great. And secondly, I thought that you had a deal where you had a significant rebadging, and I was expecting that to show up in the regional markets quite strongly. That hasn't come through. So is this something that we should expect in a more measured fashion to ramp up, or is this just something that where the contract signing hasn't happened, or it is still delayed by a quarter or two?
We don't announce a deal without a contract signing. So any deal that we have spoken about has always happened only after a contract signing. But different deals have different periods and different forms of profiles. Some involve initial transformation and then operations aspect. Some involve initial lift and shift of operations and then a transformation. So it really depends on how it plays out.
All right, thank you and best luck.
Thank you. The next question is from Ashish Chopra from Motilal Oswal Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity and I wish you a very happy new year. Rajesh, the first question I had was on the margins. So you did mention, so if we look at the current levels versus the aspired band, probably currency explains a large part of that. But if you look at currency currently, this gap could perhaps widen as a contribution from that factor. So wanted to understand, in the past we've spoken about calibrating investments basis the movements in currency. So how should we really expect, the margin trajectory were rupee to remain at current levels? Would you gradually kind of tend back to 26 or would we kind of recalibrate it?
I don't want to speculate about currency levels. What we had said about calibrating investments based on currency continues to be an overarching philosophy, but we had also said that once we commit to an investment, we stay very, very focused on that investment irrespective of where the overall currency or the margin point is. Diligenta is a great example. We stayed very deeply invested in the company, very committed to the transformation over 10 years. And that has really made us stand out compared to many others who attempted similar kind of deal structures. So our commitment to any investment that we start is absolutely limitless. We will stay with it. It is not a quarter-on-quarter kind of a phenomenon. The impact of currency on the business model is a well-documented fact. I think many of you have written about it. With inflation differential, there is a rational expectation that the currency depreciation will compensate for that inflation differential. And when we see currency flows and trade flows resulting in currency movements in different directions, you will see that impact on it. Long term, where does that play out? We don't know. But we are focused on executing things that we can control and calibrating the business model along the lines of what we see. As Ankur asked in the beginning, when we go into markets, we go in without, we are not deterred by margin profiles of those markets. We are more focused on what the to-be margin structures of those markets are once we scale up. And again, Europe is a great example where early investments are proving very helpful, and as we increase scale, we will see margin support coming from that market.
Got it. And just lastly from my side, so the new segment that you now break out within your verticals, which is the regional market and others, so that is like the second largest contributor to the overall top line in that breakup. Just wanted to understand why that has been really soft quarter on quarter and YOY, and if you could just share some color on what are the sub-segments over there which would be weak.
It has all the non-vertical specific segments. It has our platforms in there. It has regional markets in there. So India, Japan, all of that is there. I think Kedar can probably walk you through that. And the whole idea about clubbing all of them together into one to report was that their performance is a lot less linear than our more traditional markets. So it is nothing out of the way in that. It's a non-typical revenue profile, and that is the whole idea of clubbing it together so that you guys have visibility on what that is versus the rest of the verticals.
Fair enough, fair enough. Maybe I'll take more clarity on that offline. Thanks, that's it from my side.
Thank you. The next question is from Ashwin Mehta from Nomura. Please go ahead.
Hi, thanks for the opportunity and wish you all a very happy new year. So while quantification might be difficult to give so early on the tax reform, is it possible to give a directional sense on the direct impacts of this tax reform? Would it be negative, neutral, positive according to you?
No, Ashwin, we wouldn't like to speculate on it.
Okay. Just a follow-up in terms of insurance. So while your UK platform business is expected to recover, what are you seeing on your US insurance side, and any impacts of the recent hurricanes or fires in terms of business there?
Obviously, those are elements that do impact that business, but I would say that is why the business exists. So there might be, period to period impact, but I don't think that's a structural problem. You're not going to see US insurance hold up because of some individual events. The platform business in our pipeline on the platform business in US continues to be quite encouraging, and we are optimistic about extending the platform play from into US also. So and that's also an area that we think will provide some strength going forward.
Okay, fair enough. Thanks a lot and all the best.
Thank you.
Thank you very much. The next question is from Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks for the opportunity and Happy New Year to the management. Just on the banking, what I get to understand is it looks like the incremental spending on the first wave of digital, which looks like clients are insourcing rather than outsourcing. So what could be the reason for a decline in this quarter? It should be at least a worst case could be flat. Is it more to do with the renewal effect, which is actually impacting you, and you believe this may continue for the next couple of quarters, as you are saying that the next wave of digital investment, which they may outsource, may take a couple of quarters?
I think, as I explained earlier, the softness that we see in BFS is limited to North America, and it's pretty much due to seasonal factors, and I wouldn't read too much into it at this stage. We are not hearing any negative commentary from any of our clients with respect to their spend on whether it's on technology, and as I think there is a lot more in terms of their ability to actually structure transformation deals in the wave 2, and how the architecture and the digital stack plays out. Right. Clearly, there are 3 dimensions of spend, as I explained, along internal IT and captives and us. And depending upon what they would like to do, whether it is compliance related or whether it is more operations related, which is or more high-end technology related, it is or more IP related or competitive edge related. There are many factors that play into it, based on which a particular spend is distributed across those 3 dimensions. Right? So we are confident that this will come back, and as Rajesh explained, we continue to gain market share in the BFS amongst all the players, and we are not losing market share. Right?
Okay. Just further to that, so on the market share or the wallet share, if you look at some of your larger peers on an organic basis, actually they are growing higher than what your growth rates, as per my calculation for the 9 month, comes to 2.5 to 3%. So is it like we should not read too much in terms of one period? It could be a timing difference or it could be a portfolio specific. Why the others are growing faster despite a higher base on that?
For the calendar year, or you're talking specific to the vertical or for the whole company?
No, just for the vertical BFS.
No, I think all of the things that you said. It could be a portfolio specific, it could be a country specific, or it could be service line specific, right? All I can say is that look, we have built a lot of capabilities. We continue to add digital capabilities with the new offerings, by the quarter, and we are participating in each one of these, adequately. And in fact, as I explained earlier, the revenue growth that we have seen in digital is also contributed by our revenue uptake in digital segment from the BFSI institutions.
Okay. Thanks. Just last few, the decision making, Rajesh, if you can give both NGS and you color in terms of a decision making on the large deals. Because if you look at some lead indicators from the ISG index, it looks like the deal awards are improving. So is it you also believe that is happening in the industry, and also especially for some of the low penetrated services like IMS, is it the decision making has been improving? And second, just Ramki, on the beat tax, will even the fourth Q will not have an impact for FY18? You are saying it will start from 1Q of FY19?
So the deal momentum, we have been saying that we are seeing an improving pipeline, and we are seeing conversion on that pipeline also. So I think, as to be expected, the analysts are reporting events as they happen, while we are reporting you what we see in the pipeline, which is more forward looking. So it is in line with what we are seeing. We are seeing larger deals, we are seeing conversion of the pipeline, and that's overall optimistic. Now,
on the it is applicable for tax years starting after January 1, 2018, and we follow the financial year for the US, which is April to March. So it is really applicable for FY19, not for this current FY18.
Okay. Thanks and all the best.
Yeah.
Thank you. The next question is from Jay Doshi from Kotak Securities. Please go ahead.
Hi, thanks for the opportunity. Earlier this year, you had indicated that dividend payout to the extent of about 80% of free cash flow, and you had also indicated possibility of more consistent payout rather than lumpy payout to shareholders. However, if I look at your dividend payout for the first 9 months, it looks like we may not be anywhere close to that 80% mark in FY 2018. So how should we think about this dividend payout policy?
I think you probably misunderstood what we said. We had said that we have paid historically 80% of our free cash flow, and we don't see that ratio coming down, and we would in fact, if anything, see that improving. So and that the pattern of payout is something that we said we are considering, but if you look at it over the last 9 months, the total money returned to shareholders is a staggering 25,300 crores, which is unprecedented in this industry. So I think you should take solace from that we have no intention to move away from our very disciplined return of cash to shareholders.
Understood. So that will apply starting FY19. Is it right to assume FY18 because you had a buyback? So
I have said what I have said.
All right. Thank you so much.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments. Over to you.
Thank you. So in closing, we wrapped 2017 with a good December quarter, marked with a 9.1 revenue growth in USD terms, early strong volumes in a seasonally weak quarter, and closure of some industry-defining deals. As we have discussed during this call and earlier, with the exception of BFSI and retail, all our industry verticals grew upwards of 9.5% on an annual basis, with 4 verticals growing in double digits. So from a vertical split perspective, we see broad-based growth recovery across many verticals, while our largest BFSI has lingering weakness, which we are focused on addressing. Our investments in reskilling the workforce and research and innovation and building intellectual property products platforms are all resulting in good growth in our digital revenues, and that's showing through both in the numbers as well as in the deal flow. We signed our first $50 million deal in digital, marking a coming of age, as it were, for this technology stack. And lastly, we continue to reskill our workforce at scale, even as we recruit talented individuals across the world. We are focused on ensuring that we are able to impart to our existing workforce on an ongoing basis the skills that they need to deal with today's technology, which is showing through in our industry-leading retention rates as attrition continues to tick down on a quarter-on-quarter basis. So overall, we're quite happy with where we see ourselves. We are happy with the participation that we are seeing in the growth and transformation agenda of our customers, and the overall resonance that our unique blend of technology capability, investments in digital, our domain knowledge, and our contextual knowledge is doing to our customers, and its impact on our growth and in our deal pipeline. So once again, thank you all for joining us today, and very happy and prosperous New Year to all of you.
Thank you very much, members of management. Ladies and gentlemen, on behalf of TCS, that concludes today's conference call. Thank you for joining us, and you may now disconnect your lines.